paying yourself last. Most people pay everyone else first. Rent gets paid, the phone bill gets paid, groceries get paid, and then whatever tiny amount survives at the end of the month, that is what goes into savings, if anything goes in at all. The problem is that life always finds a way to spend whatever is left. Something comes up, something breaks, and by the end of the month, there is nothing. Again, paying yourself first means the moment your paycheck lands, a fixed amount moves straight into savings before you spend a single dollar on anything else, even if it is $50. You then build your spending life around what remains. The people who build real financial security almost always treated their future like a bill that had to be paid every single month, no matter what. Getting comfortable with bad debt. Good debt is money borrowed to acquire something that grows in value over time, like a home or a business. Bad debt is money borrowed for things that lose value immediately, while charging you high interest to carry the balance. The average credit card in the United States charges between 20 and 28% interest annually. That means carrying $1,000 on your card for a year costs you over $200 just in interest. You bought nothing new. You just paid for the privilege of owing that money. The dangerous part is not using a credit card occasionally. It is when carrying a balance starts to feel normal. That comfort is expensive, and it compounds in exactly the wrong direction. Not having a stockpile. A Federal Reserve study found that nearly 40% of American adults would struggle to cover an unexpected $400 expense without borrowing money or selling something. $400. That is one car repair, one unexpected bill. When you have no emergency fund, no buffer of any kind, life does not have to throw anything dramatic at you to knock you over. A small surprise becomes a crisis. A crisis becomes debt, and debt becomes months of going backwards. 3 to 6 months of living expenses saved somewhere you do not touch. That is the target. Start small if you have to, but without that stockpile, you are always one bad week away from losing ground. Not knowing your income and expenses. A lot of people have a rough feeling about their finances. They know roughly what comes in and roughly what goes out, but that vagueness is exactly where money quietly disappears. You cannot fix what you cannot see. Even a simple notes app or spreadsheet where you record everything that comes in and goes out each month will show you things that genuinely surprise you. Most people who do this for the first time find subscriptions they forgot about, services still charging from years ago, and small amounts that add up to a real number over 12 months. Knowing your numbers precisely is not optional. It is the foundation of everything else. Expensive hobbies. There is nothing wrong with having hobbies. Enjoying your life is not a financial mistake, but there is a pattern of hobby spending that quietly eats through money that could be building real security. The honest question is whether the enjoyment you are getting is proportional to what you are spending, and whether that money redirected would be doing something more useful. You can love your hobbies and still be intentional about what they cost you. Focusing purely on saving. Saving money is good, but saving as your only financial strategy is not enough. Here is why. Inflation is the gradual rise in prices over time. If your savings account pays 1% interest and inflation is running at 3%, you are losing 2% of your purchasing power every year. Your balance goes up, but what that money can actually buy goes down. Saving protects you from today's problems. Investing builds tomorrow's security. Growing your money through assets that appreciate over time is how you actually get ahead. You need both, not just one. Paying too much taxes. Most people pay more tax than they legally have to, and most never realize it, not because the system is cheating them, but because they are not using the tools already available to them. Retirement accounts like a 401k or an IRA let you invest before the money gets taxed, lowering what you owe today while that money grows over time. Health savings accounts, tax credits, and deductions for anyone self-employed are also widely available and widely missed. One honest conversation with a tax professional about what you might be overlooking could be worth more than months of cutting back on small daily expenses. Waiting too long to invest. Time is the most powerful force in investing, and most people waste years of it without understanding what they are giving up. The reason is compounding. Your returns earn returns of their own. Your money grows on top of its own growth. Someone who starts investing at 25, putting in $200 a month, ends up with dramatically more at retirement than someone who starts at 35 with the same contribution. Not slightly more, dramatically more. That 1 decade of difference is worth more than years of extra deposits. The best time to start was years ago. The second best time is right now, not next month, not when things feel more settled. Now. not caring. This last one is the quiet one underneath all the others. A lot of people have simply stopped paying attention to their money, not because they are irresponsible, but because it started to feel overwhelming or too far gone to bother with, so they just stopped engaging. But money does not pause because you looked away. Debt grows, inflation moves, opportunities pass, and every month of disengagement is a month you cannot get back. Caring about your money does not mean obsessing over every dollar. It means checking in regularly. It means making conscious decisions instead of just drifting. It means treating your financial life as something that belongs to you. We open this by saying these habits are not about being bad with money. That is still true. Every single one of them is fixable. Every one of them is learnable. And the fact that you watched this all the way through means you already have the one thing that changes everything, which is the decision to actually pay attention. If this helped you see something in your own finances that you had not noticed before, share it with someone who could use it. The people who need this most are usually the ones who never go looking for it.